Hello, YouTube. Did the stock market just flip? And we're going to give an update here to the stock market crash because the 10-year yield is now breaking out of the channel and getting to a price we have not seen going all the way back here to November of 2007. So we got a lot to go through. Let's jump straight in. We're going to have a look at the Fed funds rate, which is basically what the Federal Reserve charges for interest. This is the Fed chart. We're going to look at the same one here, basically showing that what's been happening since the 1980s, basically from the time I was born in 1988, we've been going lower, which means we've been channeling down. And now this most recent pattern is telling us that we have to be very mindful of this. When yields go up, it generally means the stocks go down. This is a complicated story. We're going to try to bring you a brief version of that today. So please stay tuned until the end, and we'll make sure we talk about all the stuff. All right. Welcome back to this one. This is the channel, the same thing we're talking about. Bloomberg is covering it. Larry Summers is talking about 4.75, which means he thinks we're going to go even higher. And this is important because not only do we have an inverse head and shoulders, which means if we do come down to averages, that would be bullish. Our golden cross is forming here, probably going to take about a year or so to form. So if we come down to that golden cross, that's probably also bullish. We have a W inside of here forming, which is usually a win for the bulls. And that just means that bond yields are going higher right now. We know we got the W for the win. And then we zoom out and we note that, okay, well, what was resistance is not really acting as, what was support over here, or the red line, is not really acting as resistance right now. It initially hit it, it backed off, and now we just made a new 52-week high. Not just that, it's the highest high going all the way back to 2007. So the title of the video says, since 2007, I thought you guys would like that. Remember, 2007 is not the year we crashed. We crashed when? It was good old 2008. Actually, late 2007 into 2008. There's the recession. It started right here in December. And this will be important because right now, oh my goodness, is the GDP rocking currently at 5.75. That is going to be hard to beat next quarter. So when we think about, okay, highest rate since November 2007, well, that's about right here. That's the great part where the recession started. That's called the Great Recession. That's not good. Nope. So I'm seeing all the warning signs here, and I have a pretty good note. I just tagged it and said, is this a trap? Meaning, are we really going to go higher for stocks, or do we recognize the trend has changed? New 52-week high. Does that mean we're going to go higher for longer? All right, I'm going to ask you for one favor and one favor only. If you want to follow me on Twitter, you can do that by going to the link I just shared. But if not, please consider subscribing to the channel. I would really appreciate your support. We put out stock market videos every single day, and we just love for you to be a part of our YouTube community. Thank you ahead of time and for your support. It's been really nice to see that people want to join over the last couple of weeks. It's been really refreshing. All right, so that 10-year note that we talked about, that basically just means that if we're going to get this crash signal, we talked about it on the weekend. We just got that new high. This is from about a month and a half ago. I'm seeing it happen now. It's a little bit hard to ignore. And then the flip side here is that the S&P joins Moody's in cutting U.S. banks amid tough climate. So this means that it could get even worse for the U.S. It doesn't mean the U.S. is out. It doesn't mean they're going to be done. But before we move on from this pattern, which is the 10-year yield, I want to show you one more chart here because we often talk about the 2 and 10-year yield inversion, and what that means. We showed this a while ago too. I forget on which video, but I have the lines drawn on here. And every time we have an inversion, we usually have the recession starting up to 20 months later. And the most recent inversion started here. When did we go above 1? So the most recent inversion started here. Where was it? Let's go to a 1-week chart, make it a little bit easier to see. When do we get above 1%? All right, it's right here, baby. We get above 1. We get to 1.02 in July of 2002. Inversion starts right here. Man, I should have just looked at the chart. And we extrapolate that out 20 months. Well, that's like Jan of 2024. Isn't that what we just looked at on the GDP tracker from the Fed? Those are the Fed's own tools. I think so. So if we're starting to notice that this is going down, it's good because it means the inversion is not as high, but we want to understand the reason why this happens. If we remember that most declines happen in a bear market after the Fed cuts, well, this means either that the 2-year yield is going down or the 10-year yield is going up. But either one of those doesn't matter for this formula. It's just a division. This one here does matter. 10-year yields going higher could be that Japan is now actually offering some competition. And the largest owner of the U.S. 10-year Treasury notes is Japan. That could be a big part of it. It could also just be that growth is high. inflation is high. It could be a number of things. So without overcomplicating it, let's just take it for what it's worth. A crash signal, right? Went back to March of 2022. Also goes back here to 2018, which we talked about on the weekend. So this just almost perfectly correlates with our crash signals here. We have it in 2022. We also have it here into 2023 as well. It's been very accurate. But here's what I want to focus on. Yesterday we heard about, and we're going to look here at KRE now, or the regional bank index, because now it's down by 3.5% on the week. We can note that we made it to basically the close of that first week here on KRE. And then we backed off. Now we're back here to the second week we gapped down. Why does this matter? Because of the liquidity. So when we look here, we note, okay, well, that's the closing price for a Friday close. Remember that SVB banking crisis? Well, that was us going into the weekend. That's the close. And then that's the, oh my God, we got relief. We filled the gap once, and now we went sideways. We've tested it for a second time now and rejected. So these downgrades are one thing. We can clearly see the regional bank ETF is down. However, the S&P is actually holding up. If we look here on a one-day chart, it actually got a gap up flush. So, right, gap ups are still for selling. We didn't quite get to the head and shoulders area yet. So I'm still thinking we can actually go higher, even though we closed red. And when we look here to QQQ, this is what's notably different too. Well, we're not seeing that same part here where I'm going to hide everything. We just go straight up. So we're looking at this portion right here and this portion right here, which means if we're bouncing off this uptrend, which is what we laid out yesterday for the bull case, it should be up, up, and away. Well, we're not really going up, up, and away so far. So I'm not sure what's going to happen, but we're getting a true test here from the bulls and bears, and we're ticking higher by 1 point versus yesterday. We were at 50 in the morning. So why does this matter? Well, it matters because yesterday, now we're going to pop over here to FXI, part of that below 50 DMA club we talked about yesterday. Well, because bad news is not really taking China down as much as we would have expected. So if bad news cannot take it down, yesterday it got a gap down pump up and it got a gap up flush today, basically closing out flat, down 1 cent. Well, would you say this is pretty bad news? Let's just read the headline. Bank stocks are down in August with higher funding costs seen. Decline in deposits has squeezed liquidity. We're in a tough climate. They're downgrading based on a tough climate. Cool. So bad news for China is not taking the chart down. Well, KRE's down, which means the regional bank ETF is now pushing off its 50 DMA to actually go down, but it's not really dragging down the S&P. Higher low, higher high. So we definitely have a lot of mixed signals right now. And I think the easiest way for us to try to understand that is just by looking here to that fear and greed index we looked at a second ago, where in the middle, positioning now tells us that it's going to take something to either knock us back into greed or something to knock us into fear. Until then, we're probably going to do ping pong going back and forth in the summer with low liquidity. Moves can be amplified, but ultimately we go a whole bunch of nowhere on a closing basis. There hasn't really been that much action. It's been pretty boring and slow, right? Slow fade, dead cat bounce. Now we're basically going sideways. It's boring, right? That's good. Boring in a bullish market is bullish. However, we don't want to overlook all of the things that are telling us that we want to be mindful of the risk. So without a lot to do this week, we're going to focus on NVIDIA, this $40,000 chip, which is really selling on eBay. I think it was up to 40 grand. That was the headline. It was a good thing to click on. Well, 2007, what happened then? It was housing. Well, there could be some kind of so that was a residential housing crisis. Well, now we're talking about over $1 trillion in commercial real estate. So that same thing that happened in 2007 could be happening here in 2008. That has odd similarities. We also note that we have NVIDIA, the king of AI. So if NVIDIA delivers earnings of either good or bad, I don't really care. I care about the reaction. Is the stock going to form that island reversal we talked about where it gaps down dramatically? Or are they going to guide higher because they're sold out of all their chips? They're having a really hard time selling them. Chips selling for 40 grand on eBay tells me that, hey, there's more demand than they're able to supply. Everyone wants them. Every country, every company. So that likely should feed through here. And we talked about NVIDIA being on the beat crew for what we're expecting. We're expecting a beat, but I think it's going to really be about the guidance here. And then it's all about the big man, Jerome Powell, on Friday. So without overcomplicating it, there's definitely some confirmation here. I think the bulls got a little bit too euphoric this morning. Oh my God, yes, gap and go. And we talked about it yesterday too, what we needed to see. Well, we got part of it. And technically we're closing back above that uptrend, but it kind of fizzled, right? The high of the day is basically the open. So open and sell. The resellers there all day to meet them. So I'm really not sure here. Shorts are covering, which means that these are probably longs unwinding their position. Let's finish off today by just quickly going through this 50 DMA club. So S&P still below, QQQ below, Apple below, Microsoft below, Nvidia above the king. So this is actually giving it a little bit of a breather here relative to what happened on the last earnings. Is that going to be enough for it to gap up another 20% and hold that range? That's a massive island right here, massive hole. Nvidia strong, can't deny it. Tesla, hey, looks like the Cybertruck's not so ugly like I called it yesterday. Stonk wants to go up. SMH below. ARC way below. DAX below. EEM below. Nikkei below. What's this one here? Ethereum below. Bitcoin below. FXI below. Are you noticing the trend? I hope you are. So if you want to watch more, the weekend video should now be queued up here on the left-hand side. But if you want to see how I take all of these notes to formulate a plan, you can go to thealgo.com for a 14-day free trial to see exactly what's in my portfolio. And if you want to trade with me, if not, thank you so much for watching. I look forward to seeing you tomorrow. Thank you again.